I'm Dr. Mahima Birla, Faculty, Area of Banking and Business Economics in the Department of Faculty of Management Studies, Pacific University, Udaipur. The topic of my lecture is the role, objective and instruments of monetary policy in India. Monetary policy, also known as the credit policy, is the policy formulated by the Central Bank of India in coordination with the Finance Ministry of India to control the supply of money and amount of credit in the economy. It could also be said that monetary policy is the management of the expansion and contraction of the volume of money in circulation for the purpose of attaining the goal of desired economic growth. Monetary policy, as I have said, is governed by the Central Bank of India, that is the Reserve Bank of India. Monetary policy uses both monetary and non-monetary measures to influence saving, investment, output, income, price level and various other important variables in the economy. Thus, it can be stated that the monetary policy regulates first, the supply of money in the economy at a point of time. Second, it also sees the availability of money. And third, the cost of money or the rate of interest to attain stability and growth in the economy. If I talk about the objectives of monetary policy, the main objective of monetary policy is to attain macroeconomic stability by maintaining price stability and adequate flow of credit to the productive sectors of the economy. Some of the important objectives of the monetary policy or the credit policies are: first, price stability. It is the most important objective of the monetary policy because as RBI makes efforts to control price stability through various monetary measures. Under price stability, the fluctuation in prices are controlled to have positive impact on production, income and employment generation in the economy. So, as such, to have development and growth in the economy, the most important thing is to have the price stability. In absence of price stability, inflationary and deflationary conditions are generated in the economy which affects the various sectors of the economy. The second objective can be stated as exchange rate stability. It is one of the traditional objectives of the monetary policy. Exchange rate stability means to minimize the rate of fluctuation in the value of a currency in respect to the value of another currency. Thus, stability in exchange rate will lead to outflow of money and encourage development of international trade, which leads to favorable balance of payment situation in the economy and will boost the international trade and terms of trade situation in the country. Third objective can be stated as the neutrality of money. Neutrality of money means to keep the impact of change in the quantity of money on various elements like price, income, employment as constant. Neutrality of money does not mean that the supply of money is perfectly inelastic and fixed, but it rather means to control the effectiveness of money in the circulation of money. Full employment can be stated as the fourth major objective of the monetary policy. Here, full employment does not mean zero unemployment. Rather, it is a situation in which the resources are utilized to the optimum level and the resources are not left idle in the economy. Economic development is yet another major objective of the monetary policy. The objective of economic development differs in both type of, that is the developing and the developed economy. In a developing economy, monetary policy encourages economic development by attaining equilibrium between money, supply and demand. Economic development and the capital formation are closely related, and the monetary policy through its quantitative and qualitative measures accelerate saving, investment and capital formation for rapid economic development. If I talk about the role of monetary policy, it is one of the most important economic policy in India. The monetary policy cannot directly influence the economic growth, but it can provide a conducive environment that encourages growth through low and stable prices. When prices are stable, people can effectively plan to invest, save and consume. When there are indications of excess supply of money and rising inflationary pressures, the bank adopt the dear or restrictive monetary policy through the contraction of credit. On the other hand, when there is low money supply in the economy, that is, in the deflationary situations, bank through cheap or expansionary money policy increase the supply of money in order to stimulate domestic demand. RBI announces its monetary policy every year in the month of April, which is followed by 3 quarterly review in July, October and January. But RBI at its discretion can announce it at any point of time. In order to completely understand the mechanism of monetary policy and how does it attain the objective of economic growth, it is very important to understand the various instruments of monetary policy. The tools or the instruments of the monetary policy can be broadly classified into 2 categories. One, quantitative or the general credit control techniques. Second, the selective credit control techniques. To begin with, I'll start with the quantitative or the general techniques. These techniques are applied to increase or decrease the supply of credit in the economy and is applied on the economy as a whole. The various techniques of quantitative credit control are: first, bank rate. It is the rate at which the commercial banks borrow from the Reserve Bank. It is also known as the discount rate, as it is the rate at which the RBI rediscounts bill of exchange or the first class securities of the commercial banks. At the time of inflation, when the supply of money is more in the economy, RBI adopts the dear money policy. It increases the bank rate, making the credit costlier for the commercial banks. The commercial banks in turn disburse loans at a higher rate of interest, thereby discouraging the demand for credit among the people. This ultimately leads to lower demand and the price level is lowered. Contrary to it, at the time of deflation, when the supply of money is low in the economy, RBI adopts the cheap money policy. It reduces the bank rate, making the credit cheaper. The commercial banks can borrow money at a lower rate from the RBI and in turn charges lower rate of interest from the public, increasing their purchasing power and encouraging production and investment in the economy. The second important instrument is open market operations. Under the open market operations, RBI purchase and sell government securities in the open market. At the time of inflation, RBI sell the government security to the public, reducing their purchasing power and thereby reducing the demand. At the time of deflation, RBI purchases the security, leading to increase in the supply of money in the economy, thus increase the demand and price level. Another or the third important tool is cash reserve ratio, also known as CRR. Every commercial bank has to keep a certain percentage of its total deposits in the form of cash with the RBI. At the time of inflation, RBI increases the CRR, and at the time of deflation, it reduces CRR. Thus, CRR affects the credit creation capacity of the commercial banks. SLR, the fourth important tool, in which every commercial bank has to keep a certain percentage of its total deposits in the form of liquid assets with itself. RBI increases or decreases the SLR as per the situation of the economy. To come up with the selective techniques, these measures regulate the flow of credit from non-productive uses to essential uses. Some of these measures are: first, marginal requirement. Margin is the difference between the amount of borrowing and the price of security. RBI increases the marginal requirement when it wants to decrease the supply of money and decrease it when it wants to increase the supply of money in the economy. The second method is rationing of credit. Under it, RBI fixes the quantum of credit for the borrower. RBI uses these measures to restrict the limit of loan and advances. The third method is regulation of consumer credit. Under this measure, restrictions are imposed on the purchase of consumer goods. The payment time is fixed or the installments are reduced to control supply of credit. The fourth method is moral suasion. Through this measure, RBI tries to morally persuade the commercial banks to follow the policies and guidelines of RBI and seek desired cooperation from the banks. The last and the stringent method is the direct action. When any commercial bank do not follow the directions of RBI, it take direct action against the banks by refusing the discounting facility of and can even take harsh actions like charging penal rate of interest from the banks. Thus, to sum up, monetary policy is the Reserve Bank of India's money management policy to achieve the goal of economic development. Thank you.